Joining us now, I'm pleased to say, is Lisa Mantil. She is global head of the Goldman Sachs ETF Accelerator program, and I just did my best to explain it, but maybe you could set the stage for us, because a lot of people call this a white label issuer, and I know that you over at Goldman Sachs don't actually do that.
Yeah, I think we should hire you as a salesperson, Katie. You need a new job? Yes, so Goldman Sachs ETF Accelerator is exactly what you said, right? It is a digital platform that allows any investment manager to more quickly and efficiently launch, list, and manage ETFs. And I think, where the idea came from was in 2019 when the ETF rule was introduced. I'll be honest, we were a little surprised at Goldman Sachs, which is the number of clients who were picking up the phone and calling the firm and basically saying the same thing, which was, we want to get into the active ETF market, but we don't know how to do it. And so that's where ETF Accelerator came from, those client conversations, that client demand. So what are we doing? We're taking our decades of ETF expertise, our risk management capabilities, and our very specific ETF technology, pulling it all together on a digital platform and exposing it to our clients for the very first time.
What is it that's going on at your clients that's prompting them to want to start offering ETFs?
Yeah, I think it's a lot of different things. I mean, you guys have spoken a lot about the generational wealth shift. I have a 20-year-old son. I'm telling you right now, he's not going to be buying anything that isn't exchange-traded, liquid, and transparent. So I think there's a generational shift, and I think there's also just this consistent drumbeat of managers wanting to be essentially wrapper agnostic. And so we have a lot of conversations with clients who want to get into the active ETF space, given the numbers that Eric talks about all the time and how the space is exploding, but it's still a really heavy lift to get into the space.
Yeah.
And so we are renting our people, so all that expertise, the playbook, the ETF playbook, and then all of that technology so that our clients aren't going to have a super long journey that takes months and months and months. You have to hire a lot of headcount, and it's a really big upfront expense. That's what we're trying to solve.
Yeah, no doubt. It makes sense to me. I want to go over one example. You guys work with GMO.
Yes.
They were, I would say, a little late. Recently they came out. They have a ETF quality, QLTY.
Yes.
Is it $1 billion?
It
Congrats.
is on Friday. What an incredible milestone.
Yeah, that's a lot. It's hard.
They launched in November.
Yeah.
So November to August to get to $1 billion. You know how hard that is. It's tremendous.
Hard. Yeah, no, it's top 1% of launches, basically.
For sure.
How does that work? How do you work with that company, and then when you get on a market, are you the one helping them get the billion, or is that on them?
That's on them. So from a distribution perspective, we do distribution support. We do a lot of education. We have full marketing resources as well. But I think GMO and a lot of our other clients, have that kind of same journey, which is they want to get into the active ETF market as quickly as they can. They realize there's an opportunity cost for not being in there. And it's back to what I was just saying. It's really hard. And so I think they made the decision as to the other clients that we're working with to try to get to market quickly with less upfront cost.
And I know you can't talk about the pipeline specifically, but what types of clients are expressing interest right now, whether it be, institutions, whether it be hedge funds? Who are you speaking to right now?
Yeah, I think everyone is the answer, which is really fun, and it makes the job extremely challenging, but exciting as well. And so I would say a couple of things. When we launched this business, we thought it was going to be very asset manager specific. I would say it's still around 60% of the conversations we're having in the asset manager category. I will say top of mind for them, and I blame and or give you credit for this, Katie, is ETFs as a share class.
Right.
And so I think when you wrote that article a few months ago after ETF Exchange, that really ignited a lot of the conversations in the asset management segment, and that narrative has completely shifted. In January of this year, it was if the SEC allows ETF as a share class. Now it is when the SEC is going to do ETF as a share class.
How about crypto, whether it's Bitcoin or whether Ether? How big of a part of the conversation is that?
I'll be honest, it's been smaller. I think, what you will actually find interesting is the amount of hedge fund conversations that we're having. And I think that use case is actually fascinating, because when you look at hedge funds, they spent so much time trying to figure out how to diversify their investment strategy, but little time figuring out how to to diversify their investor base. And you couple that when you look at just the hedge fund data, hedge fund AUM over the last decade has basically stagnated at $3 to $3.5 trillion. So you take those two things together, and hedge fund managers are really asking themselves, what's the next evolution of their growth, and should they embrace perhaps the retail segment?